Probably not. I mean, I think the Fed is going to sound hawkish at this meeting. Even if they ratchet down to 50 basis points from 75, they're still hiking. So to me, that is not a pivot in any form or any way, shape, or form. What they might do at the December meeting, and I think the focus is very much on what they do at the December meeting, they might hike rates by 50 basis points, but then move their median dot up for 2023, suggesting a much higher terminal Fed funds rate. The market's now pricing in the terminal Fed funds rate around 5%. Really, the question for me is come mid next year, if the employment picture remains as robust as it is right now and the consumers remain resilient, what will they do then? So I think the dots in December, they have to make a decision or they have to have a good idea of what the policy outcomes are going to be for 2023. And that's really where the biggest uncertainty is in. And that's when they can sound a lot more hawkish than what the market expects.
I just wonder, here's the thing, David. I mean, listen, Jay Powell, they're all smart people, very successful. They were so wrong. Their dot plots 1 year ago were like 3% away from where they are now. I just don't understand. I know we're going to do what they tell us they're going to do, but no matter what they tell us, David, it's clear from history just 1 year ago, it could wildly change.
Well, I think you're making the point that what Powell said in 2020 was that we're going to ease and stay, we're going to stay easy for as long, and it won't have a very difficult residual impact, right? And it turned out in 21 that it did. Now we're looking at the exact opposite, where he's saying, look, there's really no rate that's not, we could go higher, we can stay higher for longer, and that's going to work out just fine, and that the economy can deal with that amount of interest rate increase. And I think that's where the fallacy is. If Powell's to be faulted for anything, it's, in my mind, to be extreme on both ends. So when we think about next year, what we're seeing in residential housing is indicative of what's going to happen. Right now, housing demand is now 50% of what it was just 6 months ago. We could see 300,000 to 400,000 job losses in residential construction. We could see 2 million job losses next year across the economy. At that point, will we actually see lower inflation? But the fact is that the Fed is going to cause us to have a material reduction in economic activity in America. And that is going to be priced into the market, along with the fact that earnings...
Has it, though, David, has it already been priced into the market? When interest rates go up, you have to discount valuations because things like free cash flow assumptions, they come down. Multiples must come down. Have they come down enough?
So I think you're exactly right. Interest rates have caused multiples to come down on today's earnings level. What has not been priced into the market is that we could have, average corporate earnings, S&P earnings, down 10% next year. And the combination of higher rates and lower earnings has not been fully priced into the market yet. Remember this, there has never been the low point in the market reached before a recession actually occurs. And the inversion of the curve is what we're seeing right now, indicating that the probability of that recession is far higher today than it was just a few months ago.
Shepard Smith here. Thanks for watching CNBC on YouTube.